G'day everyone, welcome back to another episode of Spark Your Fire. We are back again another week talking about properties, as exciting as always. And, I have to say, it's such a dynamic environment at the moment. Like who would have thought that we are now starting to see a change in terms of whether that's property prices, whether that's actually the feel across the demand that we're seeing at the moment, even though RBA has just increased another 0.25% on the cash rate again earlier this week, and we're recording this on the 10th of March at the moment. So it's just such a fascinating time, I guess, to be seeing and to be living. But and I can see John's already agreeing with me by nodding his head. But anyway, how are you, John?
I'm good, David. I'm really good. How are you doing?
Excellent, mate. Excellent. And like I said, it's never short of actions at the moment and never short of things to talk about. So, I thought, what better way to wrap up another week here at the moment to touch on a few of the interesting key topics that we thought we've seen and, and be able to share our thoughts with the listeners, I think.
Absolutely.
So I think to lead in, I guess the biggest news piece this week is RBA has pulled the trigger again on the cash rate. It's another 0.25%. Not surprisingly, I guess across the market, everyone's kind of expecting that because inflation is still way too high. It's not under control. One thing I do want to point out, though, is based on the minutes or the minutes that was released after that, there's been a slight change in the tone in terms of that. So they're saying there will be more tightening to come. Whereas I think in February's note, there will be more interest rate rises to come in the coming months. So there is a subtle difference here in March minutes. Basically, what they're planning to do here at the moment is they are bridging that expectation to say, yes, we might be having more rate rises, but at the moment we may set the ground to pause a little bit, see how the data plans out, and then make that next judgment call. I don't know, John, what do you think out of that?
Yeah, I agree. Well, certainly that's what the market is saying, hearing that the rates are going higher, but there might be a pause now. And this is what a lot of sensible people have been waiting for a while. It's like we all agree that rates needed to go higher, and that one of the biggest problems in the economy was that rates were too low. There was too much liquidity in the economy. Rates were too low. But we also, it's like after having a big meal, the body kind of needed to digest. We just needed to undo the buckle a little bit, sit back and then just process the big meal that we'd had. So the economy hasn't had a chance to process the rate rises that we've already had. So if we're going to pause here, I think that's a good thing. I think it's a good thing because we do want rates to stay higher than they were, at least in 2021. That's a healthy thing for the economy. I hate to say it, I'm a real estate guy, but it's good for the economy to have savings and capital investment. And you get that because when you have higher rates. So if they want to keep rates higher, they're going to need to pause. And it sounds like that's on the cards.
Yeah. And look, I think in honesty as well, when you think about it, there's a lot of fixed rate that's still yet to come off. Like we're only talking about, we're one quarter into this current calendar year. There's still more people rolling off fixed rates. Some families probably still haven't feel the hurt as yet with those fixed rates. But at the same time, those people who are on variable rates at the moment are starting to feel the pinch. I certainly can see that the repayment has been going up. And I do agree with you, John. I think, until based on RBA stance, they're basically not going to stop. I mean, their indicator was very clear last month. We're going to do whatever it takes to tame the inflation at this point in time, right? That's the primary goal. And that could be at collateral of, say, the mortgage holders, unfortunately, or the economy as such. My read of it is there's going to be more pain to come at this point in time, at least not in the short term. We're talking about maybe 6 or 12 months. The rates will probably stay at this level, if not maybe another 1 or 2 rises. But actually, that raises a good point, John. I haven't asked you this question. We're not a betting man, but what do you think it will be the terminal rate? What do you think is going to be the terminal rate for RBA? Like, when are they actually going to stop based on the data that you have seen so far?
That's a good question. Let me have a think while I Google something, because I want to answer that question. I always try to look at the Australian 2-year yield.
Oh, yes. You always got an innovative way of working that out.
All right. So the 2-year yield is 3.47 or 3.48.
Okay.
So history tells us that that's what the central banks follow. So what's the rate at the moment? Because
we are on 3.6% at the moment.
Oh, really?
Cash rate is already at 3.6.
So the RBA, the Fed, they all track the 2-year yield, and if they're above the 2-year yield, they ought to be stopping here. I mean, I'm not saying that the next rate move is down, but if we've gone past the 2-year yield, that creates some problems for the central banks. It means they're probably too tight where we are. And you know how it always takes one rate rise too many to sort of light the fire and crash the thing. So we might be closer to that. But yeah, I'm not good at terminal rates. I mean, I didn't think that the Fed and the RBA were going to do what they did. I really thought that they would just let the inflation burn a bit because I didn't think that they were going to be as hawkish on inflation as they are for a couple of reasons. And they've proved me very wrong. So predicting what's in the mind of central bankers is just way beyond my pay grade.
Yeah, I know you're not a betting man, but why 2-year yield? If that's a newbie question. Again.
That's just history. Why? Because they're essentially sort of setting the overnight rate, but 2-year yield is generally speaking the extent of time that you can fix.
Okay,
but I don't know why it always tracks the 2-year yield, but that tends to be what they track.
Okay. Yeah. So you're saying 2-year yield at the moment is what, 3.47 or something?
Yeah. Let's say 3.5 for.
Okay. So yeah, that's why they're saying. I mean, cash rate at the moment is after Tuesday this week it's sitting at 3.6%. So we are now heading towards a bit of a tighter from a monetary policy perspective, based on past experiences. Okay. All right, well, let's see. But yeah, look, like I mentioned, RBA has softened in their tone in the latest minutes, and I reckon in another week or two they'll have their full minutes coming out. So there might be a bit more, something that we can pull apart a bit more later on, and then we'll see what they say.
Look, one other thing, the other factor is something that we did want to talk about, which I think this leads us nicely into, is what happens to the Australian dollar and what does the Fed do? So if the Fed in the US is going to continue to raise, we might have no choice. Just to maintain the value of the Australian dollar, we might need to put rates up beyond that which the local economy can support. But because we don't want to crash the Australian dollar and lead to a panic in the currency markets, we might need to just follow suit and raise rates a little bit further.
And
so that's definitely the case. Yeah.
That's going to cause a lot of pain to the mortgage holders in Australia, because our debt level is completely different to the US debt level in any other countries, right? I think we're one of the top 3 or 4 highest debt countries from a mortgage perspective. So there's already a lot of people suffering right now on that. But if we are forced to increase cash rate further, which means the bank's going to pass them on to the borrowers. I don't know what's really going to happen to the property market, John. It's a bit of uncertainty, I think, but
for sure. Look, I don't think real estate is the only game in town when we're talking about real estate, because we also know that there are fairly substantial shortages of housing. We know that the immigration spigots are wide open at the moment. So we are, I would say we're sleepwalking, but into a housing shortage. But I think we're already in a fairly substantial housing shortage. We did that gold to real estate ratio last week, which suggests that, compared to other assets where real estate is starting to look cheap. And then we've got the yield. So rents have gone up very quickly, making real estate look compelling again. So I think that interest rates are a very important aspect to the real estate market, and it's a very real estate sensitive asset. But there is a time when, given how fast real estate has fallen, that it becomes cheaper than alternatives, and that's when investors start to come into the market. And I think we're already seeing that, and we can go through some data in a moment, but we might be very close to that point already. So interest rates are going to have less and less impact because it's already baked in.
Interesting though, I gotta say, so and I think that's a good leading into I guess the data that we're talking about, because looking at the Corelogic data by the end of February, Sydney for the first time is recording a positive figure, for the month, and that was 0.3% increase. If we pull that apart, houses actually increased for the first time as well, 0.3%, even though it's a very, very small increase, but it is a positive figure that we've been seeing. How long has it been a negative figure? I can't remember, John. About 10 months?
13 months? Yeah, oh, yeah.
A lot longer, isn't it?
A year.
A year. Okay, about a year. Okay. So now it's about time to turn. And units is about 0.1% positive. So both in the positive territory for the first time, which is interesting because when you thought about it, RBA has just increased the rate, another cash rate, 0.25%. Interest rates getting higher. Everyone's repayment goes up. You would have thought that it should continue to slide on the prices, but that hasn't really happened. Now, according to Corelogic, I guess the key headline they had was the value decline flattened because of the low advertised stock level, keeping a floor on the prices. So what they're saying is, we are basically the amount of supply at the moment is just not available or not enough for the amount of demand. And therefore, we're now reaching to a point where we're seeing an equilibrium. And that's why we're essentially probably going to see small positive figures, I reckon, from this point onwards. We're not going to see like 1% or 2% increases, nothing like what we're seeing in the last 2 years during COVID period. But now it's going to go towards stabilization because we know there's no stock available to buy. Even if people want to buy, there's nothing to buy. Okay, well, the remainder of the buyers will have to compete against what's currently available on the market. And that's what's setting the floor, isn't it?
Yeah, look, that's right. Supply is the built-in shock absorber. We treat real estate like it's just another investment class like stocks or bonds, but actually only a small part of the real estate market is for investors, about 30%. 70% are people's homes. So whether the market goes up or the market goes down, it's still acting as its primary function, which is accommodation. And so, yes, interest rates will go up, but that doesn't mean people are going to sell. Particularly, not everyone bought in the last 2 years at the height of the market. Most people bought before that. So we have to think about real estate as a slightly different beast. It's accommodation. You don't sell the minute you think it's. I mean, I think most people who own real estate think it's probably going to go down a little bit further. But and if it was BHP shares, you'd probably sell those. But it's your house, so you're not going to. So yes, so supply is a big part of it, and I think supply is down. I think it's about 25% over the last.
You got much data around that, John?
Yeah. So look, I do indeed. So it varies per capital, but the number of listings is down 15.5% over the same period last year. And remember, it was drying up this period last year.
So that was Australia-wide, 15.4%.
That's Australia-wide. But if you look at the big capitals, so that's 15% Australia-wide. Sydney's supply is down 21%. Melbourne is down 19.5%, and Brisbane is down 17%. I think Brisbane's just getting started too, so I think you'll see a decline there. This is offset by what we just declared last week was the most overvalued market, which is Hobart. Hobart's supply is coming on, so Hobart has had nearly a 9% increase in supply. So yeah, so if you're in Sydney, there's 21% fewer properties to buy than last year, and over the average of the last 5 years, we're down like 20%.
Which is absolutely, like I said, there's nothing to buy, basically, isn't it? In comparison to previous years and all that. And it makes sense because I guess the sellers at the moment are still not confident that they can get the price that they want. Therefore, why would they put the property out there as well? So, which is, that's kind of just fueling a vicious circle at the moment. Nobody wants to put their house out. There's nothing to buy. Therefore, yeah.
So what I was speaking to some folks yesterday, one of whom was a property manager, and the property manager, and he's in the eastern suburbs, and he was saying that he's lost quite a few properties that he's managing to investors selling. So he says that there's a real influx that's just getting started of investors selling their properties because even though the rents are going up, they're not going up enough to cover the interest. So that sort of flies in the face a little bit of the, and it's only anecdotal, flies in the face a little bit of the there's nothing to buy. But maybe we start to see supply come on as investors start to sell. But that's an anecdote. We'll see. We'll see. I still think people sit on their hands when the market goes down.
If they can hold, and I guess it comes down to, if they're able to hold, if the cash flow is still looking pretty positive, then I'm pretty sure that investors wouldn't want to be able to sell at this point in time. Most of them probably have to sell because of the fact that the owner-occupier mortgage is getting too much, and the repayment's getting way too high. So therefore, they're going to have to basically sell one or two properties to try to basically get the debt down, be able to take a bit of profit, and to cover that mortgage, basically. So
if you're an investor and you encounter distress over the next 6 months, and there will be a lot of people. There will be. So there's let's say rents are 10% higher than they were, but your repayments would be higher than that. You can tax deduct the difference. The trick, however, is that you have to manage your cash flow, tax return to tax return sort of thing. So it still will flush some people out of the market, but investors might be better placed to weather the storm than, say, very recent owner occupiers. The only thing I'd say about recent owner occupiers, they will go through pain, but most recent owner occupiers have one property. It's their one asset, and are they going to sell? Probably not.
They're most likely maybe taking on a second job or additional income just to hold on to it and make sure they can afford the repayment, isn't it?
Exactly.
So, yeah. Okay. All right. No, thanks for sharing that, John. I think that was good. What's happening in the auction market at the moment? Can you give us a bit of idea on?
Yeah. So the auction clearance rates were, well, for Sydney, let's say, they have been over 70% this year. So there's maybe, let's say, 5 good auction weekends, maybe 4 this year so far. And all of them have been over 70% in Sydney. Really, really good stuff. Now, we know that 70%, the reason we talk about 70% as though it means something is because when the market's over 70%, the clearance rates, that tends to lead to higher prices. It's exactly what we're seeing. So the Corelogic data that tells us that prices are going up does correspond to clearance rates that are over 70%. So the week before last, the clearance rates were about 74%. The week before that, it was about 74%. Last week, it was about 71%. And then if you sort of go further into the numbers, where we're seeing the clearance rates the highest, in Sydney at least, are the premium areas. Eastern suburbs in particular, Lower North Shore, Northern Beaches, a little bit in the inner west. And the reason that's interesting is because, as we discussed last week, the premium segment got hit the hardest and went down the fastest. But actually, the premium part of the market bottomed in about November last year. So that was seeing the premium market do really well. Kind of ties into the data a little bit. So that's what, and I think partly it's because there's a perception that there's value there, but also when we say premium, I think we're talking about finished product, new houses, renovated houses. People don't want to build or renovate at the moment, so they're paying their premium to get finished properties as well. So that's what's interesting. I went to an auction in Hunters Hill in the last 10 days, and it was busy, and it went 1.5 million over the original estimate. So it was, a lot of those, that end is doing quite well again.
And I think you mentioned also, I think Chinese buyers are starting to popping back up again, isn't it? Especially in that premium market. Have you got much more to share there?
Nothing firm, other than I read a Sydney Morning Herald article about it, that there's a lot of Chinese buyers in some of those premium segments. It's potentially related to, a bit of a capital flight, perhaps. But it definitely, Chinese buyers are back.
Yeah. Okay. So auction clearance numbers are looking healthy at the moment in Sydney, at least. And that, I guess, that corresponds to the Corelogic data, which is said that's why it's starting to see a bit of a positive green shoot coming out. John, I know we're in March at the moment, and generally speaking, this is starting to get into the busy season leading up to Easter, if I'm not mistaken. Would this be seasonal? Would you reckon these numbers are due to that seasonal nature, or not really?
That's a good question. I don't know. I think that, the weather's still good. It's a good time to sell. sun shining, all those sorts of things. I'm not sure if there's a seasonal factor. And the reason I say that I'm not sure about it is because I think COVID threw a lot of that stuff out. I think the regular season's about, the influx of supply coming in spring, which is sort of that September, October, November period. That didn't happen. So there might be a massive deferral of decision making to the people who would have sold last year. Maybe they've held on to the current quarter, but I think all bets are off, at least for another year or so, in terms of what the normal pattern is, because we didn't see that big spring selling season kick in. And if prices are low, what's the incentive to bring for there to be supply in the market? So, yeah, it's hard to read at the moment. I think the cycle's a bit broken at the moment.
Okay, so we're deviating from the norm, and I think thanks to COVID, that basically disrupted everything, including the seasonal cycles that we usually see. But now I guess we will have to start looking and forming a new kind of pattern post COVID, I guess. Yeah. Okay. All right. And I just thought that was an interesting question. I just thought, definitely out of blue. So, rents. From what I'm hearing at the moment, even though rents increases have softened a little bit, but it's still going pretty strong at the moment across Sydney. I don't know whether you heard much about that, John, but when I jump on, say, realestate.com.au, have a look at one of those, Waterloo units, say 221, they built so many of them around Waterloo, right? Still renting at about $1,000 to $1,200. I was like, what? I can't believe. I thought, that in my personal opinion, I would have thought that you can only get maybe around 800, 900 max. That would be a reasonable price. But now they're sitting way over $1,000, and I don't even know how people can afford paying that, in honesty. And it's just a stock standard 2-bedroom. You know how those brand new off the plan type apartments, white walls, everything. I don't know how they justify paying $1,200 to that extent, and I don't even know how they can advertise it. But that just shows such a big chronic shortage on the rental properties that's available at the moment for rent. But have you heard much about any kind of is the rent still skyrocketing at the moment, from your understanding?
Yeah, they are. So rents are up 10.1%, but that's nationwide, houses and units. 10.1% over the previous year. In Sydney, it's 12%. Brisbane and Adelaide and Perth are going up more like 13%. But the devil's in the detail, because it's units that are really driving this. So even in Sydney, you've got the rents are going up at about 19% per annum. But that's phenomenal. And so houses are going up at about 8 or 9%. And that kind of makes sense, because the minute you open the immigration spigot, you're going to get a lot of students in, and they're going to be looking for apartments. And most people sort of rent apartments, particularly younger people. So it's absolutely, it's the rental yield is sort of the unsung, quiet little sweet spot for property investors. Now, I think we kind of have a tendency to alienate real estate investors a little bit, and I think that we do that at our peril, because that's where a lot of the investment property supply comes from. Being good to landlords is how you get rents down, and typically Australia is essentially an inexpensive rental market, because we have things like negative gearing, which makes real estate investing attractive, but what it does is suppress rents, and we just need to be careful that we don't demonize our landlords, because they're making all this supply available and keeping rents down. And we don't often, if you compare places with negative gearing like Australia to places without negative gearing like Europe and the US, their rents are relatively much higher. Hong Kong, for example, very expensive rents. So I've got a recent example myself of a very, very old apartment in, let's just say, a very small lower North Shore suburb, beginning with A and ending with Artarmon. And
it's given away.
Like a 15-year-old carpet, and the rents just got renewed at plus 20%.
Wow, amazing.
No improvements to the property. So it's really, really happening. So
how long did it take to get that rented out? 1 week. How many groups through? Just out of curiosity.
11.
Okay. One open, 11 groups. How many offers, or how many people signed
Just the one.
Just the one?
But
Okay.
this secret landlord that shall not be named. They did put the rent up what they even thought it was worth based on comparables, and the offer was
came in
above,
higher.
came in higher,
Came in
higher
higher.
than the asking price as well. So
Wow.
look, this is just a brief moment in time. It's not always going to be like this, but you don't want to be so discouraging of property investment that, and simultaneously have such population growth without there being a casualty, and the casualties are the renters. Now, the only reason why you mentioned who can afford this, how do we afford this? The answer is that renters are mobile. Property owners aren't mobile. They can't buy and sell quite as easily, but renters they can be out within sort of 30 days and they can find somewhere cheaper. So there is a kind of a fluidity and mobility about renters that, which is what the factor that makes this possible, putting the rents up. But yeah, it's brutal. It's brutal.
Yeah, it's absolutely brutal out there at the moment, I have to say. We're seeing what vacancy rate in Sydney at the moment is below 1% now, which I don't think we've seen that for a long time, isn't it? Right. So yeah, absolutely nothing to rent. And if you turn your eye everywhere, and looking at rental renewals, at least $100 more, easy. And if you don't want it, someone else will take it. So that's just the current situation. But circling back from a property investor's view, with this skyrocketing rents, and I think we touched on this a few times, it's making Sydney a bit more attractive now in terms of coming back as an investment from an investment perspective, isn't it? Because the gross rent continues to rise as the rent goes up. I don't even know what gross rent is currently sitting at the moment for units or houses in Sydney, but this is paving the path for, I guess, the years to come for property investors to surge back into Sydney. And whether that could be houses, that could be units, whatever. But I think, the Sydney market is one of those that property investors haven't looked at for a long time because of the poor rental yield. But yeah, everything goes in cycles. So, I think in the next couple of years, property investors are going to be looking at Sydney again and finding yields being attractive, and then start buying again the city.
Yeah. So rising rents make the interest rate story less relevant. So if you're an investor, you're making more money because of the rents. I mean, there's that frictional period where the rents have to catch up to the mortgage repayments.
Correct.
But then if you're a renter, the higher rents then change the buy-rent equation. So as rents go up, they're going to be sort of ushered back into being a buyer. So you're right. We're sowing the seed because the monetary policy has been so erratic. We've either had our foot on the accelerator or our hand, pulling up the handbrake. We're being sort of reckless in both directions. Now we're too tight, and it's pushing kind of investing decisions sort of back and forth like this, sort of erratic drunken sailor who's walking around the street. So, there are consequences to having such erratic monetary policy in both directions. So yeah, we'll see. But I kind of see where you're going with this. Like there's a real case to be made that property is a very good place to be for the next couple of years.
And I think, John, I reckon this is a perfect opportunity to bring this up. You are a true follower of the 18-year rule, is my understanding.
Yeah.
Now, just to, I guess, for some listeners may not be familiar with that, could you explain at high level what that means?
So the 18-year cycle is a hypothesis that came out in about the 90s that said that real estate moves in an 18-year cycle. Now, the 18-year cycle is made up of two waves higher. There's the first wave of 6 or 7 years, which goes higher gently, but it is the first stage in a bull market. Then there's a 2-year decline. Let's call that 2018-19, just for argument's sake.
Sure.
And then there's another, I think, 7-year period. But the second 7-year period in this 18-year cycle is far more dynamic, far more aggressive. So it goes up a lot faster. Let's say 2021, 2020, and so on. Now, the 18-year cycle, by my calculations, I could be wrong, because when does the 18-year cycle start is the big question. What year do you choose? But if we choose 2012 as the bottom of the previous cycle, the next 18-year cycle should peak out in 2026. And now there is one thing I didn't mention after the second wave higher, then there's a 4-year correction period. Let's call it 2008 to 2012, a 4-year correction period that according to this, it starts in about 2026, maybe 2025. The reason this is relevant is that maybe we're still in a bull market. Who knows? But I think we sort of jump at shadows and look at individual months and days and weeks, but maybe we're going to look at the real estate market as though it's a beast that has a decade or two long expiry date. And so maybe we're still in the bull market, and maybe we're chugging along until 2026, and the COVID mischief was just a little bit of an interruption. Maybe we're on track for 2026 where it tops out.
And I think certainly, at this current rate, I mean, we are already starting to see a rebound, or some more. Maybe it's too early to tell because we only got 1 month of data so far. But based on our observations on the ground at the moment, and talking to agents, Sydney is certainly starting to come back. We're seeing demands at the moment. Shortages is just from the supply perspective, and as soon as rate starts to pause, and people started to get a bit more certainty around things, that's when people, as you mentioned before, they were deferring their decisions. But once we get a bit more clarity, there might be more stock coming up for sale, for buy as well. And also, this is not to try to retrofit the 18-year rule, but funny enough, I think last week, Bill Evans from Westpac, being the chief economist there, has came out and say he's predicting there will be 7 rate cuts in 2024 and 2025. Okay, so wow, that's 7 rate cuts. Okay, obviously he mentioned before that there will be a bit more hurt to be done, so the rate will continue to go up, which is fair enough. We don't know how many, but he believes that RBA will be doing it way too much. It's too tight, and therefore it's going to kill the economy. And in order to refuel the economy again, RBA is going to have to drop rates up to 7 times in order to revitalize the economy. And just I guess pause for a minute. What's the effect of having a 0.25% times 7, which essentially is about 175 basis points? So we are today at 3.6% cash rate. 175 basis point is probably about close to 50% of where we stand. So at high level, what Bill Evans is saying, by 2024, 2025, RBAs probably have to halve the current interest rate in order to revitalize the economy again. And by that time, if it does happen, again, this is just a prediction. This is not concrete, just a prediction. If that does happen, it's going to cause massive shoot up on property prices again, because the demand's going to get refueled again into that. And that kind of lines to me quite nicely to the 18-year rule, because you're saying the peak, the next peak is going to be around the 2025, 2026 period. If rates go down around 2024, 2025, and like I said, we're not trying to retrofit the story here. We're just trying to say, here's what the market's saying, and here's what the 18-year rule theory is saying. Is there a pattern here that we can see that's coming?
Oh, look, it's anyone's guess. It's very interesting. I didn't know about the Bill Evans prediction of 7 rate cuts until you mentioned it to me today. So it's fascinating. Look, it's definitely possible. It's definitely possible. I mean, my overarching kind of feeling is I still think we have a very minor leg down again. I still think that there's a little bit of room left on the downside in Sydney. Okay. Immaterial, but minor. I think we end, I don't know, 2023, who knows? But then, 24, 25, and 26. There's 3 years where you could grind out 7% growth a year, which is very average. And then we're at the top of the cycle again. So we'll see. COVID changed a lot of things. So maybe the cycle got broken.
I guess it's yet to see, but yeah, it's just interesting when you try to marry up these different equations, and you can start to see an emerging pattern there. Now, whether that's going to come true or not, who knows? But I guess we'll find out in the coming months to see what the data will tell us.
Yeah.
All right, sounds good, John. Anything else you want to chip in?
No, but great chat. Really great chat. I like how we try to predict, but you never know, right? I mean, all the predictions are going to be wrong. That's the problem with the future. But I look forward to chatting to you again soon.
Yep, no problem. Thanks, John. Thanks for joining me today. And I guess to our listeners, thank you all for joining us today as well. If you got any questions about today's episode, feel free to just drop it as email or leave a comment below. And again, we're just talking generic. It's not specific advice. We're just talking about generic. And in honesty, it's just like two guys having a bit of a yarn about what the property market is like at the moment. That's what we want. That's what we're trying to basically get this segment to. So I hope you all guys will like it. And again, we'll see you guys again in the next episode of Spark Your Fire. Cheers, John and David.